in hot Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, August 10th, 2025. In today's podcast, our focus is on the U.S. stock market, particularly the S&P 500's recent stall at its July 31st all-time high, and just how much more upside there may be in the current April rebound as the index has risen by 33% since a lot of investors were scared out of the market during the 21% decline from the Feb highs that we had earlier this year, February 19th to be exact. And then we're too scared to get back in during the 33% pretty aggressive move back to new highs that follow the decline. These kind of markets are really tricky. They really play with your emotions. If you allow your emotions and fear and greed to influence your trading and your investing, two things often happen. It's happened to all of us. First, you lose money as the market declines, and then you lose opportunity when the market bottoms and starts to rise from the lows. So it's kind of a 1-2 punch and you get hurt twice. A lot of us experienced this in a big way in 2008, and many of this I think are experiencing the same thing now, but just on a little smaller scale. Systematic data-driven investing, which is what we do and what we believe in, stops that from happening by just following the money, following the data. In today's podcast, I'm going to show you some of our own indicators and models that we use to keep us from making those very same mistakes. Before we get started, though, here's a little bit of information about us. Asbury Research is a registered investment advisor. We're an RIA, and we have been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service available. Number one is our flagship Asbury Premium product, which we launched in 2005 when we launched the company. This is for more serious investors. It includes the latest updates on all of our data-driven models, some ETF picks, and some personal one-on-one instruction on how to implement these various tools in your portfolio. We also have which is relatively new. It's a couple years old now. We also have our entry-level Substack newsletter for $25 a month. You can find that at asburyresearch.substack.com. It does not include any of our trading models, but it has selected portions of our premium research product. There's also a free version of that service. So if you like our videos, if you're coming to our Follow the Money podcasts and like our approach to markets, I strongly suggest that you sign up for the free version of the Substack newsletter. It's a no-brainer. It's free. You can do that again at asburyresearch.substack.com, and that is what the page actually looks like. We're going to be coming back here in just a little bit, take a look at the short report. But we also offer managed accounts for both individual investors and also for financial advisors and portfolio managers as a third-party manager. We're starting to do a lot more business in this area and would be happy to schedule a quick Zoom with you to show you our 4 model portfolios, see if they might be a good fit for you. Year to date, 3 of those 4 models, Asbury Aggressive, Asbury Balance, and Asbury Conservative, are all outperforming the S&P 500 and with lower drawdowns and better risk-adjusted numbers than the S&P 500. Our Asbury Ultra Conservative model, which is the only one that is not outperforming the S&P year to date, we're trailing the S&P right now by 1.1% a year, but the maximum drawdown for this really conservative model is only 6.2% compared to 18.9% for the S&P 500. And since inception, which goes 7 years back, the biggest drawdown it's ever had is 9.3% versus what we have 33.9% for the S&P 500. That was during COVID. So if you're an older, risk-averse investor, this one might be a great way for you to play the game with less risk. For more information about this or to set up a consultation with us, just go to the contact tab and let us know what you're interested in, and we'll see if we can schedule a call for you. So enough of that stuff. Let's start looking at markets and seeing where we're at. The Asbury 6, which we're going right to the research center here. You can see all of our models are right at the top. We're going to go to the Asbury 6. And the Asbury 6 is negative as of July the 31st. That was the peak. That was the day that we made the all-time intraday high, and then we ended up closing quite a bit down from those highs for the session. The A6, as we call it, shifted to negative again on July the 31st after previously being positive since April the 23rd. You can see we went to positive here on April the 23rd. We had a little short little in and out here, out on June 17th, right back in on June the 23rd, and now you see we're out on July the 31st. Does a pretty good job over time in finding the short-term highs and the short-term lows. Right now, we're 3 and 3. We're 3 green and 3 red. So that means that the model is in balance, but it still retains the previous signal from July the 31st, which is 4 or more red. In order for the A6 to turn back to positive, it would have to have 4 or more green constituents here. And you can see we only have 3. It indicates the market's in balance, and we're likely to get the next tactical directional move from this balance point. So the A6 is the daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse metrics, which we selected and put together via quantitative backtesting. Every individual indicator has an Achilles heel. There's no indicator works all the time. That's probably the most popular question that I get. What's your favorite indicator? I don't have one because none of them work all the time. The key is taking multiple indicators that do multiple things, putting them together, which is how we build our models, and now you've got something that's a lot more robust. So year to date, the A6 has outperformed the S&P 500 by about 2%, but with half of the drawdown, only 9.6% versus 18.9% for the S&P, an 8% lower standard deviation, which basically measures how bumpy your P&L statement looks, and less than half the beta, which is another way to measure the volatility going on in your account. This means the Asbury 6's volatility, again, is significantly lower than the overall market and indicates a more consistent market returns with lower risk. Here's the chart of the A6 versus inception. Here's A6 versus inception. Inception for us was the beginning of Q4 of 2017, which gives us about 8 years of data looking backwards. The S&P 500 is in blue, and the A6 is in green. So what you can see most of the time, the A6 is outperforming the S&P 500. There are times where they come back and kind of meet like they did at the peak in early 2022, before we had the market decline of that year. They came back in at the beginning of 2025, but we actually did the math on this. 85% of the time, the A6 is over the S&P. It's outperforming the S&P. You're looking at it as a day-to-day basis all the way through this chart. It's about 85% of the time. The downside for some investors with the A6 is that's pretty active. About 11 round turns per year, again, annualized going back to the end of 2017. But the upside, again, it typically performs better over time and with just a fraction of the risk. Our CPM model, as we change views, we're going to go back to the research center. CPM stands for the Correction Protection Model. It's our first model. It's right here in the research center. It is risk on as of April the 24th. So here is April the 24th. You can see we have been green or risk on since then. Looking backwards, we were risk on at the beginning of November of 2023. We've had a couple minor moves here, did a pretty good job of catching the highs in the middle of December and at the end of February. And again, we are on a pretty sustained risk on signal for CPM. What CPM is a completely data-driven, dynamic stock and bond allocation model. It was designed to be an alternative to the standard 60-40 portfolio that most advisors will set up some kind of a version of 60 stocks and 40 bonds. Sometimes it'll be 60-30 with some gold and some international, but generally speaking, that 60-40 portfolio is a set it and forget it. You get asked a series of investment related questions by your advisor, and they say, based on your answers, we have you in something that is in the neighborhood of a 60-40 portfolio. And then it's set it and forget it. And they hope that the bonds, when the market goes down, the bond portion of that 60-40 is going to save you. But as we've seen over previous years, it doesn't really work anymore. Sometimes stocks and bonds go up and down at the same time. Let me change views again and show you why we are much bigger fans of this. So this is CPM going back again since our inception date, which is Q4 of 2017. And AOR is an ETF that represents a 60-40 portfolio. So you can see CPM has greatly outperformed that 60-40 portfolio, up 100, let's call it 148% since Q4 of 2017, versus only 70, let's call it 71% for the that 60-40 ETF. AOR is the ticker. The thing I like even more is when we look at the numbers. So the annualized total return of CPM, as shown on that chart, 12.24% a year. AOR, which is, again, it's representative, it's an ETF that's representative of a 60-40 portfolio, only 7.02%. And look at the drawdowns. The drawdown in AOR, which is a 60-40 portfolio, 23%. Drawdown in CPM is only 20s. So your performance has been twice as good with a little less drawdown. Standard deviation is a little higher for CPM, but again, it doesn't hold any bonds. It's strictly stocks. We're either in the market or out of the market, staying in the stock market. Beta is about the same. So this is why we are really big advocates of the CPM. It's designed to protect investor assets during market declines, eliminate the large drawdowns, as you saw there, and reduce the volatility in portfolios by moving assets out of the market during adverse conditions. CPM is binary. It's either risk on, which means we are in SPY, which is the ETF that tracks the S&P 500, or when we're risk off, we are in BIL, which is an ETF that tracks the yield of an 8 to 13 week US Treasury bill, which right now is around 4.2%. So CPM, a lot less active than the A6, about 5 round turns a year. And we can turn CPM into an alpha generating model by using some leverage. Instead of trading it with SPY, we'll use the leveraged ETF. That's a little bit beyond the scope what we want to talk about today, but we can turn CPM into an aggressive model because it performs well with much lower drawdowns. That separation between how it performs and small drawdowns enables us to use it as a offensive minded model just by changing the vehicle that we're trading. The A6 and the CPM are both a part of our premium service, the one that we launched in 2005 that has all of our models. You can contact us to get more information about either of them at asburyresearch.com and go into the contact. Next thing we're going to look at, and we looked at this last week, but I think it it's important. I think it bears repeating. Drawdowns. You always hear me talk about drawdowns. Why are drawdowns so important? They're not so important if you're 30. You can dollar cost average for a long time and basically get a nice average price of all your investing life. I equate it to playing football in the first quarter. In the first quarter, you can take chances. You can take some shots because you have time on your side. There's a lot of time to play the game. Once you get into the fourth quarter, which I think as an older investor, which I am, and what I, from our studies, most of the people who track us, who track Asbury Research, are older investors. That's like playing football in the fourth quarter. Now it matters. Time matters. So you change how you play the game. If you've been investing all your life and you're in the fourth quarter of your investment game, you probably have a lead. Some have a big lead, some have a small lead, but you probably have a lead. So in the fourth quarter, try to protect that lead. And we do that by limiting our drawdowns. And here's why. Take a little drawdown, 20% drawdown, or if you take a 10%, just the way the math works, if you take a 10% drawdown, you have to make 11% the other way to get that back. No problem. If you got a 20% drawdown, you got to make 25% back. Not terrible. Once you start to get into the 30s, if you take a 30% drawdown, you need to get 43% back the other way in order to get to your old peak. So let's just look at recent history. The COVID collapse was 34%. So just kind of doing the math in my head a little bit, 34% collapse, that's going to put you somewhere closing in on 50% you have to make back the other way. So it does matter, and it matters even more if you're withdrawing money out of your account. If you're at that point where you're 73 years old and you have to start to draw the money out of your IRA, that becomes even more important because the bigger drawdowns that you have compounded with the money that is coming out for your distributions, you get yourself into a lot of trouble there. So that's why the drawdowns to us are such a big deal. Now let's go back to markets, and I want to look at our Keys to This Week report, and we're going to look at 3 charts here that I think are important. Keys to This Week is one of the reports that we do once a week, as the name suggests, typically at the end of the week. And Jack and I will look at 150 charts, and we'll pull 10 out that we think are the most germane to what's going on in the market right now. Every markets change. The tools that we look at to try to navigate the markets ought to change also. So the 3 that we're going to look at today, this is the cumulative volume index down here on the bottom. It's the NYSE cumulative volume index, and it measures volume on a cumulative basis, which smooths it out. If you look at a raw volume chart, they're very jumpy, they're hard to read. What this shows is once volume started expanding on a cumulative basis on April the 23rd, we had a nice move in the S&P 500. July 31st is when cumulative volume dropped underneath its 21-day moving average. 21 days is Asbury Research's tactical time period. That's why the 21. But look what's happened since then. We've got a little stall in the move higher. We are still underneath that 21-day average in CVI going into next week. As long as that remains the case, the S&P 500 is going to struggle here. It's going to struggle trying to make and hold a fresh high. So this is something that we're really focused on. The second thing is I'm going to jump over, I'm going to jump over a chart here, and then we're going to, probably saw the VIX there, we're going to come back to it. VXX is kind of a longer term look at the VIX. This is the iPath Series B S&P 500 VIX short-term futures ETM. That's like a paragraph, but that's the name of this. The reason we're looking at this, it's a little smoother than the VIX. And what it's showing us is that this particular index, which moves with the VIX, is testing this extreme of 40. It's an extreme in complacency. The last 3 times that we were there were February 19th, top in the market, December 5th, smaller top in the market that actually led to the February top, and then the top that we made in July of 2024, which is pretty significant. This isn't a signal for us to go ahead and go short yet, but this does tell us that based on this metric, which measures volatility, historically the market's probably at or near some kind of at least a monthly peak. Now, if we go to the VIX here and look at the raw VIX, we can see that the VIX is trading right on its 21-day moving average here in blue. If it gets up above there, that level is currently at 1657. That's going to be, for us, that's going to be the trigger that the market is now afraid enough to where we can actually have a sustained move down. So watch volatility, watch volume next week. They're going to be really critical to what happens next week. Tuesday of next week, we have CPI, which is an inflation gauge, which the market is really concerned about inflation. And on Thursday is PPI. So all of this is kind of coming to a head that we should see around the middle of next week. Now let's take an updated look at our sort report. Our sort report is a part of our, here we go. This is a part of Chart Focus, which is a Substack newsletter, asburyresearch.substack.com. And what this does, the sort report tells us which parts of the global market have positive trends, are outperforming their benchmarks. Let's make it a little bigger. Outperforming their benchmarks and have positive asset flows, which means that new money is pushing those ETFs higher. This is a very low-cost way. It's a $25 a month service. I think it's $250 for a year. Low-cost way to make better investment decisions based on data, not opinion or economic forecasts. Remember, forecasting is a euphemism for guessing. We believe in following the money. What this is telling us right now, heading into next week, is there are 3 of this 10 broad asset classes, which include emerging markets and crypto and crude oil and commodities. There are 3 that are currently positive on trend, on relative performance, and on the money flows. They are gold, U.S. technology, we use QQQ for that, and global equities ex-US, which is SPDW. GLD is what we're using for gold. So what does that mean? Looking at all of these particular 3 assets are where you should be looking for opportunities, because the trend is up, they're outperforming their peers, and their money flows are expanding. So there you go. That wraps up our latest Asbury Research Following the Money podcast, and shortly I'll be off to watch the first preseason game of my beloved Chicago Bears. Our next Follow the Money podcast is tentatively scheduled for Sunday, April 24th. For those who like to watch my interviews, next week on Monday, which will be the 11th, August the 11th, I'll be appearing on CNBC Arabia on Monday morning, right around the opening in New York, about 8:30 Chicago time. And then on Wednesday, I'll be interviewed on the Schwab Network, Charles Schwab Network, on Wednesday the 13th at about 9:15 a.m. To discuss Asbury Research's latest take on the markets. You can have access to the replays on all of these by simply signing up to the Substack newsletter, the free version, at asburyresearch.substack.com. For questions or more information on any of the research models or model portfolios we talked about today, you can contact us via the contact tab right here at asburyresearch.com. And please don't forget to like and subscribe. Go Bears. See you in 2 weeks.